Stop watching the buyers stepping in front of this train. Right now, at 0.7000 flat, you are not looking at a discount, you're looking at the bait. There is one danger zone that is about to liquidate every late retail long from the Asian Open, and one hidden opportunity hiding below a 4-hour demand cluster that most traders don't even see. I'll show you both right now. The Australian dollar is trending strongly on every time frame below the weekly, and the momentum isn't just organic selling, it's a positioning reset linked to a yield differential collapse. Stay to the end. I'm giving you 3 exact levels you can trade today, including the sniper entry that nobody is watching, and the aggressive play for traders who understand that risk happens fast. We have negative divergence, we have an ADX screaming above 51, and we have a liquidity grab waiting to happen. Do not enter a single position until you see this. The session bias is a fade on rips and a sell on strength. We are in a strong sell environment, and you need to treat any pop toward the 0.7014 resistance as a gift to get short. We are not ranging here. We are repricing risk assets. Write this number down. If we accept a 4-hour candle body above 0.7031 today, the entire bearish structure resets, and we push for a breakout toward the 200-hour moving average. But until that happens, the path of least resistance is a violent sweep of the 0.6997 support to trigger the stops resting just below the round number. Here's what the herd is doing. They are looking at the monthly strong buy signal, thinking this is a dip worth buying because the 200-day moving average is sloping up at 0.6897. They are wrong. The herd is confusing a long-term structural anchor with a short-term entry trigger. This is the classic mistake that transfers money from patient capital to impatient speculators. The daily trend is strong sell, the 5-hour trend is strong sell, and the 1-hour trend is strong sell. Aligning against that without a massive divergence is account suicide. Let's fly up to the weekly chart to understand why the floor is falling out. We are currently trading at 0.7000, and the weekly moving averages are telling a story of exhaustion. The 20-week moving average is rolling over, and price is accelerating away from it. This is no longer a gentle pullback, this is a momentum crash. The 200-week moving average, the institutional anchor, is sitting way down at 0.6897, and I believe that level acts as a magnetic target over the next 2 weeks. Gravity is pulling price toward that long-term mean, and the path there is littered with stop losses. Dropping down to the daily chart, the technical damage is severe. We have a bearish crossover of the 5 and 10 period moving averages versus the 20 period. The MACD on the daily is printing -4 pips of negative histogram expansion. This isn't a weakening bearish trend. This is an acceleration. Look at the ADX reading, 51.78. Anything above 50 signals an extreme trend. There is no divergence here to fade it. The market is trended, and trend followers are pressing shorts into every minor retracement. Now, let's get into the execution timeframes, the 4-hour and the 60-minute, because that is where the money is made today. On the 4-hour, the MA20 is at 0.7065, and price is trading below it by a mile. The MA60 is overhead acting as dynamic resistance. Here's what most traders miss: the negative correlation with the risk pulse. The VIX structure and the S&P 500 futures are flashing warning signs, and the Aussie dollar is moving tick for tick with the unwind of carry trades. We are the risk barometer. When global liquidity tightens, the Australian dollar does not just fall, it free falls. Look at the 60-minute chart. The MA5 is at 0.7015, and the MA10 is at 0.7034. Price is trading well below both. This is a bear flag breakdown. The RSI on the 1-hour is at 36, not yet oversold. This tells me there is room to fall before we get a mechanical bounce. The stochastics are at 30, still pointing lower. The Williams percent range is at -86, deeply embedded in bearish territory but not curling up yet. This is a continuation signal, not a reversal one. The immediate ceiling is the pivot point at 0.7007, a level that price is currently failing to recapture, confirming intraday seller aggression. The critical level is the support at 0.6997. That is the session low, and below it sits 0.6990 and then the high volume node at 0.6980. The structure below 0.7000 is thin air. There is a liquidity void there, and voids get filled at high velocity. Here's the hidden divergence that the screens aren't screaming yet. On the 1-hour chart, every attempt to bounce is met with a lower high. The MACD on the 1-hour is attempting to curl, but the signal line remains in extreme negative territory. We call this a hidden bearish divergence where price consolidates while momentum reloads for the next leg down. This is the technician's green light to hold shorts. The CCI reading of -121 confirms we are outside the normal distribution band, but in a strong trend, extreme CCI readings can persist for days. If you wait for the CCI to normalize back to zero before shorting, you'll miss the entire move. Do we need to talk about the Asia proxy effect? The Australian dollar is not just a currency pair. It is a liquid proxy for Chinese demand expectations and iron ore futures. Overnight, we saw weakness in the commodity complex, and that is bleeding directly into the AUD. The sell-off is synchronized, and until that macro correlation breaks, every bounce in this pair is a sale. The moving averages are perfectly stacked for a bearish continuation. The MA50 is at 0.7094, the MA100 is at 0.7032, and the MA200 is at 0.6897. The MA100 is rolling over and about to cross below the MA50, a formation we call the death cross precursor. When that triggers, it attracts algorithmic selling. The 0.7014 resistance is not just a random number. It aligns with the previous structural support turned resistance. The 0.7024 is the high of the Asian range, and 0.7031 is the breakout zone. Until one of those levels is reclaimed on a closing basis, the short side owns this market. The sell-off in the last 24 hours isn't a mystery, it's a yield differential massacre. The Australian dollar is getting crushed by the widening spread between US real yields and Australian bond yields. The Reserve Bank of Australia is caught in a narrative trap where they are perceived to be behind the curve on easing, while the Federal Reserve holds rates higher for longer. The interest rate differential is collapsing, and carry trades that had piled into the Aussie dollar for years are unwinding violently. This is the ghost of policy divergence, and it hits the Aussie harder than any other G10 currency. The latest market sentiment shows a sharp pivot toward fear on the global growth outlook. Analyst pieces released in the last cycle are slashing their Aussie forecasts, and this creates a self-fulfilling prophecy of downward revisions that if you are trading gold, you see the divergence immediately. Gold is holding firm on geopolitical bid while the Aussie dollar slides. This tells you that the move in Australian dollar to US dollar is not a pure USD strength story. It is an AUD weakness story, which makes it even more durable. A commodity currency falling while commodities remain relatively bid is a flashing red signal for a risk-off. Acceleration. Crosscheck Bitcoin. Bitcoin is holding its range, but the beta to the Nasdaq is rising. If the S&P 500 futures break below their gamma flip levels, the correlation will drag the AUD down further, as leveraged funds sell risk proxies to cover margin calls. The cross-asset linkage confirms that the Australian dollar is the cleanest risk-off short in the G10 space right now. My 2-week directional lean is bearish until we trade into the 0.6897 handle. The weekly sell signal is just starting its cycle. The event that invalidates this lean is a daily close above the 0.7065 level. That's the MA20 on the daily. If we get back above that, the trend reversal chatter starts, and we exit shorts. But until then, the macro tailwind is at our backs. Here's the interaction trigger. Do you think the Aussie dollar tests the 0.6897 200 weekly moving average this month? Comment yes or no right now. I'm tracking consensus to see if the crowd is too bearish or not bearish enough. Most people skip this section. That's exactly where the money is made. Keep watching. Before we enter anything, understand the volatility footprint. The ATR is 53 pips. Adjust your position sizing accordingly. We are not trading a dead market. We're trading an angry 1. Strategy 1, the sniper, conservative. This is the sell limit on the retest of the breakdown zone. The exact trigger condition is a 1-hour close below 0.6997, followed by a retest of that broken level from underneath. Wait for a bearish rejection wick on the 5-minute chart at the 0.6997 to 0.7000 zone. Once you see a lower high form on the 15-minute, you execute the sell. The stop loss goes at 0.7017, just above the pivot point and the intraday liquidity high, giving you a 20 pip buffer. The logic is simple. If the retest of 0.7000 holds, the longs are trapped and forced to liquidate, fueling the drop. Take profit 1 is 0.6980, the daily S3 support and the high volume node. That's a 17 pip scalp. Take profit 2 is 0.6960, a 3.7 to 1 risk-reward extension. What voids this setup entirely is a 1-hour closeback above 0.7017. If that happens, the breakout is a fake, and we step aside. Entry, 0.6999, sell limit upon 1H close below 0.6997 and failed retest, stop loss, 0.7017 take profit 1, 0.6980 take profit 2, 0.6960 risk, reward, 1:2.1 are invalidation. Void if 1H candle closes back above 0.7017 strategy 2. The active trader, standard. This is the momentum chase. Entry condition is a break and 4-hour candle open below 0.6990. You don't wait for a retest. You sell the strength of the candle close with a market order, expecting continuation into the Asian liquidity vacuum. The stop placement is at 0.7010, a tight 20 pip stop based on the hourly resistance flip. The reasoning here is that if buyers step in and push price back above 0.7010, the momentum is broken, and the trade is wrong. Take profit 1 is 0.6975, just above the psychological extreme of 0.6980 to clear any slippage. Once target 1 is hit, move the stop to break even and let the runner ride. Target 2 is the 0.6950 liquidity pool, a level where we see resting institutional bids. This offers a risk-reward of roughly 1:3. The trailing stop rule is strict. Once target 1 is hit, trail the stop manually to 0.7000 or use a 20 pip trailing stop on the 1 hour to lock in gains as the trend extends. Entry, 0.6989, market sell on 4H candle open below 0.6990, stop loss, 0.7010 take profit 1, 0.6975 take profit 2, 0.6950 risk, reward, 1:3.0 are invalidation. Void if 1H candle reclaims 0.7010 before we go aggressive. Type your Australian dollar to US dollar range for tomorrow in the comments now. Let's see who's aligned with the 0.6980 target strategy. 3. The aggressor, high risk. This is for those who can lose small and manage risk aggressively. We are fading the herd's panic. The aggressor entry is a counter-trend long if we spike into the 0.6980 support and don't break it on the first touch. Wait for a 15-minute bullish engulfing candle right at 0.6980, with a 15-minute RSI dipping below 25 and then immediately snapping back above 30. This is a mechanical oversold scalp against the trend. The stop loss is extremely tight, 0.6972, just 8 pips below the support. The logic is that if the level breaks, the trend resumes, and you need to be out instantly. Target 1 is the rapid retest of 0.7000, a 20 pip counter trend scalp for a strong risk to reward ratio. Take profit 2 is 0.7015, but only if the 1 hour candle closes above 0. 7007. Explicit warning. This is a falling knife catch. Only for those who can accept a rapid stop out and not freeze. If the order book thins out during the spike, you can get slipped. No position sizing that exceeds 0.5% risk on this 1. Entry, 0.6981, limit long on 15M bullish engulfing at 0.6980 support, stop loss, 0.6972 take profit 1, 0.7000 take profit 2, 0.7015 risk, reward, 1:2.3 invalidation, void if 15M candle closes below 0.6980 before entry triggers. We are trading in a 53 pip ATR environment. Never risk more than 1 to 2% per trade. No positions through high impact news, specifically any RBA speak or US ISM data. Stops are non-negotiable. If 0.7017 hits on the short, you're out. If 0.6972 hits on the long, you're out. This is how you survive to trade the next big move. The single most critical level for the next session is 0.6997. If we open below it and hold, we accelerate to 0.6950 within 48 hours. If we reclaim it on a closing basis, we chop sideways. Tomorrow's wildcard is the Asian Equity Open. Watch the Nikkei and the Shanghai Composite at the tone. If risk assets gap lower, the Australian dollar gaps with them, and liquidity thins out. If you want the full breakdown on the S&P 500 divergence and the gamma levels that are driving the macro bleed, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.